Yo, what's good? My name's Kang, and today we're going to be talking about why you should be maxing your ESPP. Employee Stock Purchasing Plan, or ESPP, is a benefit that allows you to contribute a certain percentage of your salary in order to purchase company stock at a discount. The benefit will automatically take money out of your paycheck and hold on to it for a holding period, usually like 3 or 6 months. And then after that holding period, they will use the money to purchase the company stock at a discount, something like 10 or 15%. Now, that could have been a little bit confusing, so let's go through an example so it makes a little bit more sense. Let's say that we have a girl named Sarah, and she works at a dating app company for kangaroos called Jumper. Let's say Sarah has a salary of $100,000 and an effective tax rate of 30%. Her company offers her an ESPP program, which allows her to contribute 10% of her salary for a 15% discount over a span of 3 months. Okay, let's say that Sarah wants to enroll into her ESPP. That means that she can contribute up to 10% of her $100,000 salary towards this program, and let's say that she does the full 10%. So Sarah's contributing $10,000 or $830 each month. Now, what's important to note is that this $10,000 is calculated on her pre-tax income, but it's actually taken out of her post-tax paycheck. Now, what does that mean? So let's take Sarah's $100,000 salary and apply that 30% tax rate that we were talking about. Now we're left with a $70,000 take-home pay. Now this take-home pay, if you divide it by 12, ends up being $5,830 per month. And this monthly paycheck of $5,830 is where the ESPP will take the money from. Okay, so now Sarah's contributing $830 each month into this ESPP program, and at the end of 3 months, it totals $2,490. This money is going to be used to buy Jumper stock at a 15% discount. And let's say over this 3-month span, Jumper went crazy, specifically in the Australia region, and the price has went from $50 all the way to $75. According to Sarah's ESPP program, she gets a 15% discount on the last day of the holding period, which happens to be the last day of the 3rd month, which means instead of getting Jumper stock at $75, she actually gets it at $63.75. You might say, whoa, that's pretty good. She automatically gets a 15% return, but it actually gets a little bit better than that. The return is an instant 17.65% return. Let me explain. Alright, so Sarah uses her $2,490 to buy Jumper shares at $63.75. With that, she's able to get 39 shares. Well, roughly 39 shares. Sarah then sells those 39 shares at $75 a piece, giving her a brand new total of $2,925. Doing some quick math, we can see that Sarah has brought home a return of $435, which ends up being a return of 17.65%. And if you ask me, that seems like a pretty good deal for basically doing absolutely nothing aside from pressing a couple buttons every 3 months. But this gets even better if your company has lookbacks. Okay, so normally with an ESPP, they're going to take the stock price at the last day of the holding period. But with a lookback, they're basically going to look at the stock price on the first day and on the last day and see which one is lower and then give you a discount on that. Okay, so for example, Jumper stock went from $50 to $75. And with a normal ESPP, they would be giving you a discount on the stock price on the last day, so $75. But with a lookback, they're going to say, hey, $50 is lower, we're going to give you a discount on that instead. Now, all of this math assumes that Sarah sells her shares immediately. But what happens if she doesn't? Keeping them is an option, but of course there's risks involved with that. The first risk that comes to mind is the stock price going down. Now, of course, you're getting it at a discount and the price could go up, but who's really to say if it's going to go up or down? And because you're taking this risk, you're losing out on a guaranteed return. And I personally think locking in that guaranteed return and rediversifying into different assets is a better idea. And the second risk that I can see is diversification. Not only are you getting paid by, the Jumper company, now you're also getting $10,000 worth of stock per year. And that's not even mentioning RSUs, which kind of segues into my next point. Why this is so important for people in tech. Most salaried employees can take advantage of ESPPs at big public companies. So why is it different, or why is it important for someone that works in tech? Most total compensation packages for folks in tech is a split between salary, stock, and bonuses. And if you are getting a pretty high percentage of your total compensation from an RSU or a stock option, it could make sense to sell some, if not all, of your ESPP and rediversify if your company has that option. Folks in tech can also take advantage of that high growth within the tech sector. Tech as an industry has been booming in the last decade or so, and if your ESPP has lookbacks, you could potentially capture some of that upside and make some serious gains, or at worst case, come out with a 17.65% return. Of course, assuming that you sell the stock immediately once you get it. With that being said, not all ESPP plans are the same. For example, Microsoft lets you contribute 15% of your salary for a 10% discount over the span of 3 months. Apple, on the other hand, lets you contribute 10% of your salary for a 15% discount over the span of 6 months. And some companies like Google or Facebook don't even offer ESPPs at all. There's a really good page on levels.fyi where it outlines all the different ESPP programs as well as other benefits for the tech companies, and I'll leave that link below. Now, personally, I think that ESPP programs are really great and is a great benefit to have, but there are, of course, some drawbacks or considerations that you have to make. For starters, there's a max amount that you can contribute to your ESPP, which is $25,000. Now, to be fair, with a 10% contribution, you would be having to make $250,000 just in base salary, so I don't think it applies to a lot of people, but it's just something to take into consideration. The second consideration is taxes. Now, I'm no tax guru, and each plan is going to have its own preferential tax stipulations, so you'd have to do research into your own ESPP plan. However, if you plan to sell those shares immediately once you get it, you're going to have to pay tax on it. Now, since you're selling it in such a short amount of time, this is going to be considered short-term capital gains tax, which means it's going to be taxed at your highest tax bracket rather than some other favorable rate. And the last consideration that I want to mention is cash flow. Like I said earlier, the contributions is calculated on your pre-tax income but taken out of your post-tax paycheck. That means that you're losing a significant amount of your paycheck, but I definitely think that if you can handle that reducing cash flow every single month, you should 100% take advantage of your ESPP. Starters, it's a free and guaranteed return. There aren't many investments out there that can give you a guaranteed return, let alone one that is 17.65%. Also, it takes very little work on your end. All you have to do is sign up for the program and click sell at the end of 3 months and maybe check your taxes at the end of the year. It also forces you to invest. By taking the money directly out of your paycheck, it doesn't give you the option to mess around and go buy something else, and it forces you to pay yourself first, which I personally think is a major key in personal finance. All right, now I'm pretty sure I have you convinced that you should be maxing your ESPP, but you probably are wondering if it's the first thing to max or if there's other investment vehicles that you should be taking advantage of. Now, personally, I like getting free money, and I'm assuming since you're watching this, you like getting free money too. So if you want to see you can get free money through your 401k, watch this video right here where I go over front loading your 401k.